bees.
I'm gonna drive that joke into the ground. I know it's getting old. Just wait.
Just wait.
Just wait. It'll get older.
It's gonna get older. Guys set?
I'm set.
All right.
La.
Do you want to tee us off?
You do it.
All right.
Yeah.
Okay.
You do a good job.
Well, what is up, everybody? HIG Podcast here. I am MattyP here with my good buddy, Bronson Kaufusi.
What's going on, everybody?
Hey, what's up, Bronson? How you doing?
Today, doing great.
All right.
Yeah. Doing awesome.
Sweet. Nice shirt. Nice Sundance shirt.
Little Sundance
Sundance
It's
love.
almost that time of the year. Hit the
is.
slopes.
It actually is that time of the year for me right now with Sundance because it's all the mountain biking.
Oh, it is that time of the year for you. Yeah. Great mountain biking.
Lots to do up there. Lots of hiking, mountain biking. I love it. And I just also want to say that this is not sponsored by Sundance. I just genuinely do love mountain biking up there.
But we do love Sundance too.
We do. It's not too far from us here. We are in Provo, Utah, here at the Harris Financial Center. 7th floor, views all around. It's kind of fun to watch storms roll in. Speaking of storms rolling in, we have a guest today here, a storm of a man.
From the East Coast.
From the East Coast. We don't get those very often here in Utah. But warmest aloha, Matt Denning.
Mahalo.
Mahalo. What's up, Matt? How you doing?
I'm doing great, guys. Thanks for having me back.
Oh, yeah. Thanks for coming back by popular demand, I might add as well. I don't know if you know this, but when you talk, when you have things to say, people want to listen.
Look at that. There you go, Matt.
More than just us. No, it is.
Doesn't happen in my home, but I'm happy to hear outside the confines something's going on.
You know, there's this weird occurrence that I've noticed. I have a lot of friends that are military. They command this great attention, but when they come home, they're just a dad. Their kids don't listen. They get just as much talk back, just as little listening as anywhere else. But we love listening to what you have to say. We love hearing your insight. So welcome to the show again. I believe this is episode 11. HIG podcast number 11.
Wow.
All right.
We're moving up. We got some big things to talk about today, man.
All right. Well, let's go.
Yeah, there's a lot going on in the markets.
There is, yeah.
There is, right? There's a lot of things that are forthcoming. There's a lot of things,
Anticipation.
Election. Yeah, there's a lot of anticipation with the election and all these different things. But I think of one thing. It's kind of funny, actually. As I've been going around and talking to different investors and firms and family offices and people, there's a big focus on the lending markets right now and what's going on there. And yeah, I'd love for you just to initially just touch on kind of your overall view of the current lending markets right now. It's really interesting.
Yeah, it is. Interest rates are a big topic right now. We are now in September and anticipating that rate cut to start the turn of the cycle with the Federal Reserve in the U.S. Other developed markets have already started that loosening, that cutting of interest rates.
Yeah.
And it's fully expected and baked into the markets here in the U.S. And it is an interesting dynamic and something that's normally misunderstood, actually, by many individuals, those who aren't in the investment market for sure, as to how exactly those interest rate cuts impact the lending market and interest rates in general.
It's a big deal.
It is. So if you look at how lenders analyze the markets in questioning how much they want to lend and at what rate, at what interest rate they want to lend at, there are a few dynamics that go into it. One is simply their balance sheet and their ability to lend. And there are reserve ratios and metrics and bad debt numbers or anticipated bad debt that gets baked into some of these calculations, which are dictated by the Federal Reserve, by the FDIC to understand how much lending power they have. And so that's something that banks are thinking about and lenders are thinking about. They're looking at potential future losses and what they need to reserve for and knowing how much they can lend today. Another thing is simply uncertainty. And you talked about anticipation. Anticipation, it's anticipating what? What are the changes that could potentially come? And in the investment market, we talk about this as a risk premium. What risk premium is in the market that is above and beyond the, in this instance, what interest rates are, what a benchmark interest rate is.
Yeah.
And that risk premium sometimes is expressed in volatility In the equity markets, we talk about the VIX index. In the bond market, there's an index called the MOVE index, which is an aggregation of bonds, which showcases the volatility in that market. And so what we've had over the last year plus is really a heightened amount of volatility in the bond market, which has driven the risk premium, one of the drivers for the risk premium, to be higher than normal.
Yeah.
And so to clarify that, just to make sure we're on the same page, so if you had a bank that was referencing, let's say, the prime rate for their loans.
Yeah.
Well, it's normally a prime rate plus something, prime rate plus 1%, plus 1.5%. That 1 or 1.5 or 2% is your risk premium. And that number has been higher than normal, or definitely higher than what it was for 2016 to 2022, 2021. And we're looking for that to come in some more. We're hoping for that to occur. So we'll see what happens there. Don't have a crystal ball, but we do have the elections that are forthcoming here. And hopefully, with the Feds actually beginning to cut interest rates, there'll be a little bit more certainty in the market that will lower that risk premium factor.
Yeah.
The other thing is simply interest rates in general and that benchmark rate and what they're at. And I think this is where things can get a little confusing or misleading for most individuals. Let's just take you and I and our mortgage, our home mortgage.
Yeah.
So we may sit here thinking to ourselves, well, let me wait another 6 months or 9 months for the Federal Reserve to really cut rates by 25 basis points, 50, 100 basis points, 1%, and that will lower my interest rate that I pay on my home. And that's actually not necessarily true. There's a correlation, but it's not a direct pathway. So to think that I will wait for the Federal Reserve to cut rates by 1%, therefore my mortgage rate will be lower by 1%, that is an incorrect statement.
Yeah.
I feel like that's a very commonly misunderstood concept.
It is.
I misunderstood it until about 8 seconds ago. I'm not going to lie.
So there's I don't want to throw out too many new terms, but there's a concept of duration. It's basically what's the average holding period of a bond. What's the duration of a bond? So some may be surprised to know that a 30-year mortgage, the average duration is about 7 to 10 years, which is stating that for those of us who have 30-year mortgages, we don't normally hold them for 30 years. The average is 7 to 10 years. Some of that is dependent on the path of interest rates, which dictate prepayment that comes sooner rather than later. Some of it is just us moving to a new home and a new market. So if you think about what mortgages are priced off of, it's actually priced off the 7 to 10 year treasury. That's the benchmark. It's not overnight rates.
That's good. Yeah.
And so as we think about what will the mortgage market do for consumers in their home, it's really not a question of, well, will the Federal Reserve cut rates by 50 basis points or 100 basis points and wait for it? It's really seeing a stabilization of the 7 or 10 year U.S. Treasury rate. That's that benchmark. Okay. And I think that we're seeing that normalization happen right now as the curve is inflecting on short-term rates. And so as we stand here today, the 10-year is about 3.8%. The question for the 10-year Treasury is more of, what's the new normal for longer-term interest rates?
Yeah.
And I think it's somewhere in the 3s. Yeah. I don't think it's going back to the 2s. I could be wrong. I'm hoping it's not going to be in the low 4s or in the 4s. Yeah. So I think we're getting close to the 10-year Treasury being around normalization. I'm not saying it couldn't go down to 3.5% or 3.25%. Yeah. It's a fool's errand sometime to predict precisely what that number will be. You never know.
Crystal ball, let's go.
Crystal ball, exactly. If you then pull it back into our markets, as far as Harris Investment Group and where we're accessing loans, we do access loans on multifamily deals that are based off of the overnight lending rate or the Federal Reserve rate. And those are what we call bridge loans. There are 2 or 3 year loans and they price off of SOFR or the Fed funds rate. And so those absolutely are impacted immediately as rates come in. But we also obtain loans, agency loans or CMBS loans that more price off of the 5-year Treasury. And the 5-year Treasury today is around 3.55%, 3.6%. And the question is, where is that normal? You know, what should the normal 5-year rate be? The 5-year rate starts to take into account cycles. So you look at what would be a normal average over the long term. Nobody would say that a 5-year Treasury or a 5-year time period is a long-term time period. It's a medium-term time period. And we start to bake in economic cycles when we think about the 5-year rate. But I'm not sure that the 5-year is going into the 2s. I don't know. I suffice it to say, though, that in my opinion, I think that we're getting close to where the 5 and 10-year Treasuries are going to flatline and normalize out at in this cycle. And now it's about the risk premium to come down a little bit more. But I think we're getting some fairly good rates right now.
So you're excited?
For those who are lending.
Okay.
That's the last caveat, though. It's for those who are lending. And because there aren't tons of banks lending, because they are still thinking about the losses that they may have in their available capital, it has still created a little bit higher rates out there. Although some banks, I think, are lending at attractive rates, they're just being highly selective with who they lend to. So interestingly enough, we obtained on a truck stop a 7.25% interest rate loan, almost at the same time in one market, almost at the same time that we obtained an 8% loan on a truck stop. Similar credit quality, similar 5-year terms, and all of the aspects about these loans seemed fairly similar, but they were in different markets with different lender pools available. And so the 8% loan definitely took into account the fact that there really weren't many options for us. Whereas the 7.25% loan, I think, was looking at more long-term opportunities with us, and I think priced it fair based on risk premium and benchmark interest rates, and they didn't bake in a lack of availability for us to lend from other pools. So it's pretty interesting as those two loans came to fruition.
No, that's super interesting. So, I mean, you just touched on the gas stations, and that's a big part of what we do here. Gas stations, truck stops, multifamily, just with all the different lending, opportunities that we've had and gone through. Is there one that was like, in your mind, that was like the hardest, or something that was, because it can be quite difficult when you're looking through so many different parameters and trying to see the best fit.
So let me answer that question. What's the most difficult for us? I think in the market right now, the lenders are also trying to understand supply that's coming online and supply that's available right now, and baking that into simply their desire to loan. Full stop. Am I even going to make a loan on this asset class? Office space, we know, has definitely had challenges in the market. It's been a big problem on the coast. It's still a bigger problem on the West Coast, I think, than the East Coast. These are not markets that we invest in, and so I can't speak from firsthand experience of obtaining a loan, but I think the office space is difficult. I think the multifamily space also has challenges right now. There's a lot of supply coming on in the Sun Belt, a lot of the markets that have been hot markets over the past few years. And I think there are banks that are trying to understand the absorption that will occur in the multifamily market with this new supply. And so multifamily is hit or miss right now. For us at Harris Investment Group, though, new construction has been the most difficult, and that's a problem across the market. As we talk about supply dynamics and what supply is coming online, lenders would like to see how this current batch of supply gets absorbed before committing to more new construction, because that can be tricky. So we have a project in Garden City, Utah, in Bear Lake, and it's been difficult to obtain a loan. Now, fortunately, we have a great local lender that knows the market, and we can talk about some nuances about this loan that made it where we actually had a couple of options. A couple of them, though, were pretty expensive. We were able to get a 10% interest rate for new construction, which
Wow.
is very, very favorable.
Yeah,
so we
very.
can talk more about that, but new construction, definitely Bear Lake, that was a challenge.
Yeah. Oh man. Yeah, for sure. New construction.
And that property that we're talking about is Bear Lake Vistas up in Garden City.
Correct.
At Bear Lake.
Yeah.
I didn't realize all the intricacies that went into that and us obtaining a loan in the market that we were in. And just for clarity, as we sit right now, we did get a loan, right? That loan was secured. It's in place.
Actually, signing the documents right now, we obtained the horizontal loan at late last year, and now we're obtaining a vertical loan for the first batch of units.
Ooh, tell us a little bit about that.
Different phases, yeah.
Yeah.
Yeah. So if you go to a local lender today, obtaining a mortgage for a home is still available, and plenty of lenders are doing that.
Yeah.
The multifamily side in general and rentals in general are more hit or miss, and that's what I was talking about on the multifamily side. You then go into this dynamic of, it's economic sensitivity and how different consumer bases react. And unfortunately, with the inflation which has occurred, not only low income, but even middle income individuals have found themselves very sensitive to the price impact that inflation has had. Mm-hmm. Whereas on the higher end, I would say upper middle income to the high income group, there's tends to be a market always to lend to that group because they're not as price sensitive. They have a better cash reserve and the like. And this Bear Lake Vistas project, speaking to some of the intricacies of the project and why we were able to find multiple lenders on this, although some very expensive, is because it is speaking to the upper middle income group as well as the upper class high income group. Mm-hmm. Maybe I can talk for a minute about what we're doing up there, just to speak through some of the intricacies.
Yeah,
Matt.
for sure.
Caribbean of the Rockies.
Yeah, the Caribbean of the Rockies.
That's what I hear online.
That's what you hear.
That's what I hear on the social media
Where's
platforms.
no first-hand experience there?
Oh, I've been there quite a bit. I agree.
You can attest.
Blue water.
It is beautiful. It is beautiful.
Cold blue water.
Yeah,
Cold
that's
blue water.
true. Yeah, that's true.
Man, and some days you come in there through the canyon, dropping down in the clouds, and it's like its own little world there.
No, it really
You
is.
drop into that beautiful lake with a mountain surrounding it, and yeah, so this project we're really excited about. For those who know Bear Lake, they understand that there's a high volume of individuals that go through in the summer, 1 million plus visitors, multiple million. But if you take the surrounding areas, but during the winter, it's quiet, right? During the spring and fall, it's fairly quiet. And why is that? It's not for a lack of things to do. During the winter, there's incredible snowmobiling. I'm not sure if any of you have participated there.
This last winter, I was up at Bear Lake. I was up at a friend's cabin. I was surprised by what there is to do, how much there actually is to do. So I remember we talked about just pulling over that crest, seeing the lake, right? Beautiful, beautiful lake. Beautiful. But it was different. It was different because there weren't like loads and loads of people around like there can be in the summer. But when we got up there, so this family friend of ours owns some property up there. They make it an annual trip. They go 2 or 3 times a winter because there is so much to do. So when I was up there, we went snowmobiling. There's a ski resort 20 minutes away.
That's building a new lodge.
It's built. I didn't even know that.
And yep.
So we went up with skis. We went up with tubes. We went up with snowmobiles. Even the little kids, all they wanted to do was build snowmans and ride those tubes, right? But I mean, it was just hours and hours of fun, not just for my little kids, but for everybody. Some groups segmented off and snowmobiled.
What'd you do for food?
We brought some food up. There were a few restaurants up there, but we ended up bringing a bunch of food up with us. We had the facility to make food, to barbecue.
Which is important because there are really only a couple of pizza joints and local bars, pubs that are open during the winter.
This is true.
And so that's tough. They do have grocery stores now that are open year round, but it's tough from a year round perspective from an amenity set
for sure.
at Bear Lake.
The struggle was real.
Exactly. You have the outdoors, you have the fun activities to do, but you find that certain groups, especially upper income individuals, they like to go snowmobiling and then come home and have that food prepared for them, and they're used to going to their country club or eating out in the restaurant.
Right.
And you don't have that. You're used to groups that may take sales teams or
That's why I was up there.
Oh, it was.
I was up there speaking to a sales team.
There you go.
Yeah. A couple times up there. So, yeah.
Well, you like to have things catered, and you find that a lot of the support staff, unfortunately, are coming in from Cache Valley, are coming in from Logan, and don't live there year-round in Garden City. And it's a struggle. And so we're trying to solve for that. There's one other project in town that has some indoor amenities year-round. And it has a pool, and it has a play area inside, a carpeted indoor gymnasium. And we need more of that in order to support the year-round individual. And what we're building up there at Bear Lake Vistas in Garden City is speaking to that year-round dynamic. And we're really, really excited about that. And so is our lender. Going back to why the lender was interested, they saw a client base that was upper middle income to upper class, and definitely are used to paying the price tag and then some of what we'll be charging for these townhomes. And they're also really excited about the year-round amenities that we're bringing to the table.
Yeah. So what are those? Yeah. Can you touch on those?
Yeah.
Big secret.
No. So first, it starts with food. And I should mention that for this 250 townhome development, we'll have the amenities exclusive to that group during the peak year. So think from Memorial Day to Labor Day, and maybe a little bit on the shoulders to the side. But then throughout the remaining part of the year, it'll be open to the broader community. And that's obviously important for us to support those amenities, because we do understand that it's a little bit of a, if you build it, they will come when we're talking about the off season.
Sure.
And so what we're looking at doing is an indoor pool. It is a bowling alley.
Oh, sweet.
It is golf simulators and a fitness center and arcade style. Think about the young kids and what they want to do and play. It is indoor pickleball courts.
Wow.
And this isn't going to be a carpeted gymnasium. This is going to be real sports courts, and something that upper middle, that all individuals would respect and value, feeling that this is high class. So we're really excited about that amenity set, as well as scattering hot tubs throughout the property that will be open year round.
Wow. So something for everyone.
Yeah. And of course, I'm lobbying for that skating rink.
You're the hockey man.
We'll flood the outdoor pickleball courts, and we'll make sure that you can skate up there.
Yeah. Wow. That sounds awesome.
Part of the lake does freeze over.
It does.
You might be able to run some sort of a hockey camp for a little bit at least.
But I know that Bronson he doesn't know much about hockey, but he'd be steering me to the part where the ice is thin, right? And he'd be checking me
go
out.
Over there.
Exactly.
Wait, I just hit the puck over there, man.
Yeah, exactly. Go. And so,
that's what we're going to score on you. So that's the only way we can score on you. We have to go and have you fall through the ice, and then we can go score on you.
That amenities list, though, sounds solid.
There's nothing like that up there.
No, there isn't.
There's
there
nothing
really
like
isn't.
that.
And I'm thinking, as a man with many kids from age 7 to 21, there's something everyone would like to do. Bowling, pickleball, golf simulator, hot tub, swimming pool.
Winter, spring, summer, fall. Yeah, year round.
And remember, too, that this is concrete tilt-up build. We're really excited about the noise factor, the insulation factor, some of these
heat retention
positives, the heat retention, exactly, that it's going to be very efficient from a heating perspective. And so there are all those exciting things. You also have simply the fact that we can use the rooftops. And we've talked about how on the individual townhomes that it can support a hot tub and grilling and all of that.
Overlooking the lake.
These are 3-story high townhomes, and so that'll be great. Also with the clubhouse, we'll make it where we can host parties, weddings on top of the clubhouse, and that'll be a nice exclusive feel, and you'll have all glass glass walls that are around the top of the clubhouse, and it'll feel somewhat private, and it'll overlook the pools but overlook the lake. Remember also with the grade that's there, the grade of the land up to a 10-degree pitch will make it where all of the rooftops have a view of the lake, but also if you go to the clubhouse, it'll be 40 feet, 45 feet above the road below. right? And just a beautiful unobstructed view of the lake.
Oh, man.
So we think it'll be really cool. We're really excited about it. Man, we wish we had a lender that would lend on 50 units to start. We're going to start at a fraction of that, but we'll get some units there that will be ready to be delivered in the springtime.
So springtime. So can people get? Is there a wait list, or how does it work?
Yeah.
Like,
So right now there is a wait list. There's a pre-order list.
Okay.
And we're selling those first units and pre-selling really for the batch next year that will be completed during the summer into the fall. So the first batch of 8 will be out of the gate, ready to be inhabited right there for Memorial Day weekend.
Wow.
And then the remaining units, the first batch, we're hoping to put another 20 to 35 up next year, and working on that clubhouse. And that's
wow.
Yeah,
that's
what
awesome.
We're looking for. Yeah.
Man, so people want to. I'm assuming so. If people want to get in touch about this, they can just email contact@harrisinvestmentgroup.com and then tell us that you're interested in Bear Lake, and then we can get them connected. But man, that is a great project. And man, tying back to lending.
And tying back to lending, though, and the challenges for our side and how we've pivoted our game plan. There are a lot of costs that expenses that we've put into this, but we know that as we get the cash flow from each sale, we really need to reinvest it back into the project because we're getting lower leveraged loans.
Yeah.
Okay? We know that the time horizon for us to, again, obtain the cash flow from the profits is going to be longer in duration because the lending market is tougher. And so it's just a pivot that we've had to make because of the lending market. Hopefully it will soften up some here next year.
Yeah.
The flip side of it is we can use the lending market. Now I'm moving beyond Bear Lake for a minute, but you use the difficult lending market to obtain better deals, a lower price when we go into a truck stop or when we go into a multifamily deal.
Yeah.
The lending market is taken into account. Really on the truck stop side, we've been able to leverage the lending market in negotiating lower purchase prices for us, which are really nice.
Yeah.
Of course, it would be great if in a year or two we can also refinance into more attractive debt.
Yeah.
We'll see how it goes. Lending it percolates throughout the market, and it has such a ripple effect, and it's something that we're always talking about here and trying to navigate.
Jeez, man, that's so great. I love talking about lending and talking about Bear Lake and getting all your insights. So thanks for coming on today, Matt. Yeah. Seriously.
Thanks for having me.
Thank you so much. And I'm excited for next week, MattyP.
Yeah. What do we got?
I don't know. We'll find someone ready to roll with us. We're gonna learn about something going on. There's just a lot of our listeners are just so interested in everything to do with real estate, the markets. They just want market insight, and so we have a lot of knowledge here at Harris Investment Group. So it's fun to just keep bringing all of our people on here and spreading the knowledge. So.
It is, yeah, and it seems like there's so many facets to what we do. It's fun to learn about the lending side, because that's really such a key principle of what we do. Yeah. And it's nice to know that we have, Matt Denning kind of helming that ship, or Maui. I watched Moana with my daughter.
You are the Maui of Harris Investment Group, Matt Denning.
Yeah.
Wow. Well, look, bring me back in mid to late October.
Okay.
We can talk a little Utah Hockey Club.
Oh, yeah.
Yes.
Still won't have a name, but we can keep working the hockey into our stories, right? We've got Chicago Blackhawks, first home game.
Jeez.
Boston Bruins, my Bruins.
Your Bruins.
Second home game. Bring the family up for that.
Yeah, that's a big deal.
I'll be at both of them, so we'll have some good talking points.
And interest rates, maybe.
And interest rates. Actually, we'll be...
we should be. Something should be happening. Some movement,
I'm trying
right?
to think when the second meeting. We've got one here in a couple of weeks, but I think it's late October. We'll have another Federal Reserve meeting. Could be the first days of November, but I think it's late October. So
we'll bring you back for sure. We love your insight. We might ask you back before then, though. Just be prepared.
Sounds good. I'll be on my toes. I'll be on my skates.
There you go.
There we go. And thank you, everybody, for listening. If you have any questions for us, email us at contact@harrisinvestmentgroup.com. In the subject line, just put HIG Podcast or whatever else you have a question about. We'd love to answer your questions here on the podcast. That's a wrap. That does it for us. Thanks for tuning in, and catch you guys on the flip side. Catch you next time.
Yeah.
Any parting words of advice and wisdom?
Let's go be great. Let's go.
Let's go be great.
Ready, break. 1, 2, 3.